There's a sound your grandmother's kitchen probably knew by heart, the soft slap of paper envelopes being laid out on the table, one by one, right after payday. Rent, food, savings. Before a single bill left her hand, it already had a job to do. No app. No spreadsheet. Just paper, a pencil, and a rule nobody had to explain twice. When the envelope is empty, you're done spending, no matter what the calendar says. Now think about today. A card taps a screen. A number changes somewhere far away. And somehow, we can spend money we don't have yet, on things we haven't paid for yet, for a version of ourselves who will figure it out later. Something got lost in that trade. Not the paper, the limit. The physical, honest stop sign that told a family, this is what we have, and this is enough. So, stick around, because we're going back to the kitchen table, to 10 envelopes that quietly kept entire families out of debt, out of panic, and out of the trap we're all living in right now. Some of these habits you'll recognize instantly. Others, your family may have already forgotten they ever had. Number 1. The rent envelope. Pay the roof first. That was the rule, and it wasn't negotiable. Picture a family in the early 1930s on payday. The husband hands over his wages. Cash, folded, still warm from his pocket. The wife sits at the table, and the very first envelope she fills, before anything else, is the one marked rent. Not because it was the most enjoyable expense, because losing the roof meant losing everything else that came after it, and the fear behind that rule was real. By 1933, somewhere between 40 and 50% of all home mortgages in the United States were in default, families falling behind on payments they simply could no longer make. At the worst point of the crisis, banks were placing more than 1,000 homes into foreclosure every single day. Against that backdrop, the families who kept their envelope system alive weren't being paranoid. They were reacting to something that was happening to their neighbors on their street that same month. Today, rent or mortgage is still the biggest line in most budgets, but it's often the first thing people try to make work, with a grace period, a partial payment, or a promise to catch up next month. The envelope didn't allow promises. It only allowed cash that was already there. If you take one thing from this video and try it this afternoon, pull your rent or mortgage amount out in cash, even just symbolically, the day you get paid, before anything else touches your account. Number 2, the food envelope. This one had a rule almost as strict as the first. You shopped with the envelope, not with hope. A mother walks into the grocer's with exact bills counted out at home. She's not guessing. She already knows, to the cent, what she can spend. Because that number was decided before she ever left the house, not while standing in the aisle. Back then, a loaf of bread ran about 9 cents. A gallon of milk, around 28 cents. A dozen eggs, roughly 42 cents. Every one of those cents was already accounted for before the front door even opened. Accounts from household guides of the era described the same pattern again and again. Meals were planned around what was already in the pantry and the icebox, and the shopping trip existed to fill the gaps, not to fill a cart. Compare that to how most of us shop now. Cart first, total second. Card covering whatever the total turns out to be. The limit moved from before the shopping trip to after it, and that single shift is where a huge amount of quiet, invisible overspending happens. The practical version today isn't about coupons or deprivation. It's about deciding the number before you walk in, envelope, app, or otherwise, and letting that number, not the checkout screen, make the decision for you. Funny thing about all this, the more I read about these 2 envelopes, the more I realized none of it was about restriction. It was about a family deciding, on their own terms, what mattered most before the world could decide it for them. That's worth sitting with for a second before we keep going. Number 3. The savings envelope. This was the envelope nobody touched. Not for a treat, not for an emergency that didn't feel emergency enough. Just untouched. Picture a woman placing a few coins into it every single week, even weeks when there wasn't much left to place. She wasn't saving toward anything specific yet. No vacation, no new furniture. She was saving because she remembered, or her mother remembered, what it looked like when a family had nothing set aside and the ground gave way underneath them. And the ground really did give way for a lot of people. Across the 1930s, roughly 9,000 banks failed in the United States. Entire families watched their deposits disappear overnight because the institution holding their money simply collapsed. After that kind of loss, cash you could hold, count, and hide in your own house stopped feeling old-fashioned. It felt like the only thing you could actually trust. Today, most of us don't distrust banks the way that generation learned to, but we've replaced that fear with something almost as risky, the assumption that there will always be more money coming, so there's no urgency to set anything aside right now. The envelope wasn't about mistrust of the future, it was about refusing to be surprised by it. The practical version: pick one envelope, physical, digital, doesn't matter, that nothing is allowed to touch except a real emergency. Not touch until it's convenient. Not touch. Period. Number 4. The repairs and maintenance envelope. A pot with a hole. A chair with a wobble. A pair of shoes with a worn-through sole. None of it got thrown out. It got fixed, and there was already money set aside to do it. Households of the era planned for wear and tear the same way they planned for rent, as a certainty, not a surprise. Something was always going to break, so there was always a small amount of cash waiting for exactly that moment, enough to pay someone to resole a shoe or patch a roof without touching the rent envelope or the food envelope to cover it. Compare that to now. Between 2004 and 2012 alone, the share of household appliances that failed within just 5 years more than doubled, from 3.5% to 8.3%. We didn't get clumsier with our belongings. Plenty of what we buy today is designed to be replaced, not repaired, and most of us don't have a separate envelope waiting for the moment something breaks, so the fix becomes a new purchase instead. If you want to bring this one back, before you replace something that breaks, ask what it would cost to repair it first, and keep a small things break fund, so that question isn't a financial emergency every time. I'll be honest, writing this section made me look at my own kitchen drawer of broken things I'll fix eventually. There's a version of this habit most of us already have, we just stopped finishing it. Number 5. The clothing envelope. New clothes weren't a mood. They were a decision, made slowly, with cash that had been building for months. A family didn't walk into a store because a shirt looked nice that week. They walked in because the money for a new coat had finally been set aside, coin by coin, since the season before. And even then, most clothing got mended long before it got replaced. A torn hem, a missing button, a patch on the knee, these weren't embarrassing. They were just Tuesday. Compare that to today, where the average American now throws away roughly 82 pounds of clothing every single year. Much of it barely worn, some of it never worn at all. We didn't get harder on our clothes, we got easier on ourselves about replacing them, because a new shirt is cheap, fast, and one tap away, with no envelope standing between the impulse and the purchase. You don't have to sew your own coat to bring this back. Try setting a real amount aside before you shop for clothes, and before anything gets tossed, ask if it can be mended, tailored, or handed down first. Number 6. The emergency/rainy day envelope. This was the envelope that existed for nothing in particular, and everything, all at once. A broken window, a sick child, a husband laid off with no warning. Families of the era knew the something was coming. They just didn't know which something, or when. So there was always a small stash set aside for exactly that kind of day, untouched by ordinary spending, and never, ever borrowed from, to cover something as small as a nice-to-have. According to the Federal Reserve's own survey of household finances, 37% of Americans today say they could not cover a sudden $400 expense with cash on hand. Not a house fire, not a lost job, just $400. A flat tire, a broken appliance, a copay. That's more than 1 in 3 households one flat tire away from a real crisis. The envelope wasn't fear-based hoarding. It was the quiet confidence of knowing that whatever knocked on the door next, there was already something waiting behind it to answer. If nothing else from this whole video, start here. Even $20 a week into an envelope nobody else can touch is $1,000 by the end of the year. Enough to make most emergencies a minor inconvenience instead of a crisis. 2 envelopes in, and I keep coming back to the same feeling. This was never about having more money. It was about deciding ahead of time what each dollar was already for. Let's keep going. Number 7. The utilities envelope. The lights stayed on because the money for the lights was never touched for anything else. Not once. Not just this month. Families of the era treated the power bill, the water bill, and the gas bill the same way they treated rent, as fixed, non-negotiable, paid the moment the envelope allowed it. There was no, "I'll catch up next paycheck." The shame of a shutoff was real, and so the money was set aside before it could be spent on anything more exciting. Today, roughly 1 in 6 American households is behind on their energy bills, and utility companies disconnected power more than 13 million times in 2024 alone. That's not 1 in 6 households living recklessly. It's 1 in 6 households where the gap between income and rising costs finally caught up. But it's also a reminder of what the envelope protected against: the quiet, compounding panic of a bill you can't pay, becoming a bill you can't pay, plus a reconnection fee plus a deposit. The practical version: treat your utilities like rent. Money set aside the day it's due, not the day it's overdue. Number 8. The gift and holiday envelope. Nobody wants to be the family that ruins Christmas by explaining it, calmly, to a child. So this envelope started filling up in January. This wasn't just a habit, it was practically an institution. Banks across the country ran Christmas Club accounts, where families deposited a little cash every week, all year, specifically so December wouldn't wreck the budget. Even in the depths of the Depression, in 1934, banks in one Pennsylvania county alone distributed $500,000 to 15,000 families through exactly this kind of account. Money that had been quietly building since the previous Christmas, ready the moment it was needed. Compare that to now. Americans who took on holiday debt in 2025 borrowed an average of $1,223 to cover it. Money that, for many, is still being paid off well into spring. The envelope didn't eliminate the desire to celebrate generously. It just made sure generosity in December didn't become regret in February. Try this. Open a separate holiday fund today, literally any amount, and let next December be the first one in years that starts with cash instead of a balance. 2 more envelopes down, and here's what keeps striking me. None of this was about denying joy. The Christmas Club existed so the joy could happen without the hangover. That's not restriction. That's just planning ahead of the moment that matters. Number 9. The empty envelope rule. This is the one that made the whole system unbreakable. When an envelope was empty, spending in that category stopped. Not slowed down. Not, we'll figure it out. Stopped. The way a locked door stops you. Not because you couldn't force it, but because everyone in the house had already agreed you wouldn't. Picture the scene. It's a Wednesday. The food envelope is thin, and dinner that night is simpler than it was on Monday. Beans instead of meat, bread instead of dessert. Nobody panics. Nobody borrows a few dollars from the rent envelope sitting right there on the shelf, in plain sight, technically reachable. The money in that envelope had a job, and dinner wasn't it. An empty envelope wasn't a failure. It was the household's own honest signal, in cash, that a limit had been reached. Full stop. No negotiation. No, just this once. It turns out there's real science behind why this worked so well, decades before anyone studied it. In 2017, economist Richard Thaler won the Nobel Prize in economics for showing that people don't actually treat money as one single, interchangeable pool the way classical economics assumed. We mentally sort it into separate categories: rent, food, fun money, and we protect each category differently, even when, on paper, a dollar is a dollar no matter where it came from. Thaler called this mental accounting, and he specifically used household budgets, rent, food, utilities, as his clearest real-world example of the theory in action. In other words, the envelope system wasn't quaint or old-fashioned. It was, generations ahead of the research, a physical version of exactly the mechanism a Nobel-winning economist would later prove actually changes behavior. Today, almost nothing in our spending works this way. A declined card is rare and embarrassing enough that most of us set our limits high, specifically to avoid it. A low balance notification is easy to swipe away without reading. Nothing physically runs out in front of us the way an empty envelope on the kitchen shelf does, so the signal to stop has to come from willpower alone, which is exactly the thing money systems are supposed to protect us from needing. Bring this back simply. Pick one category, eating out, or clothes, or whatever tempts you most, and put a hard cash or prepaid card limit on it specifically. When it's gone until next month. No exceptions, no, I'll just put it on the card this once. Number 10. No envelope for debt. Here's the detail that says more than almost anything else on this list. There was no envelope for debt in this system, because for most of these families, there was no card sitting in a wallet making debt this easy to reach for in the first place. The credit card, as we understand it today, simply didn't exist yet. It wouldn't be invented until 1950, years after this era, when a New York businessman, embarrassed after forgetting his wallet at dinner, helped launch what became the first modern charge card. Before that, there was no revolving balance quietly growing in the background of a family's finances. No minimum payment designed to make a debt feel smaller than it was. No interest compounding month after month while nobody was watching closely. If a family didn't have the cash for something, the honest answer was simple, even when it wasn't comfortable. Not yet. Today, Americans collectively carry more than $1.25 trillion in credit card debt, averaging roughly $9,300 per household. Say that number slowly and it barely sounds real. And it would have been almost incomprehensible to a family filling envelopes at that kitchen table in 1935. Not because they were smarter or more disciplined than we are. Because the entire system that makes debt this easy, this invisible, and this easy to normalize simply hadn't been built yet for them to fall into. This isn't about shame for anyone carrying a balance right now. A lot of that debt comes from genuine emergencies, the exact kind the rainy day envelope was built to absorb before it ever became debt at all. It's about noticing the real difference between a system with a built-in stop sign and one quietly engineered, almost invisibly, to remove it altogether. The practical version? Pick one card, one balance, one number, and build your own debt envelope in reverse. A fixed amount every single month that goes only toward paying that balance down, treated with the exact same non-negotiable respect the rent envelope once got at that kitchen table. 10 envelopes. 10 small, quiet decisions, made before the money ever had the chance to make itself scarce, or make itself into a problem. No app tracked any of it. No bank sent a warning. Just paper, a pencil, and a family sitting at a table, deciding ahead of time what actually mattered to them and what didn't. Maybe we don't need to go all the way back to 1935. Nobody's asking you to give up your card, count coins by lamplight, or bake your own bread out of necessity instead of choice. Progress is real, and most of us wouldn't trade it away even if we could. But somewhere between that kitchen table and this exact moment, we traded something else along with it. A limit, a physical, honest stop sign that used to sit between the impulse and the purchase, quietly doing its job before we ever had to rely on willpower alone. Maybe we could stand to borrow just a little of that back. Not as punishment, not as guilt over every coffee or takeout order. That's not what any of this was ever about. Just a small, deliberate decision, made ahead of time, about what our money is actually for, before the world quietly decides it for us instead. Because that's really the thread running through this whole video. It was never nostalgia for hardship, and it was never about people being tougher or wiser than we are. It's simply this. Somewhere in our own family trees, someone already knew exactly how to do this. We're allowed to remember it. We're even allowed to be a little proud of them for it. If this one hit home, do us a favor, hit like, and if you haven't already, subscribe. We bring one of these every single week. And honestly, it's how more people find their way back to this kind of thinking before it disappears entirely. And if you want to keep going, we made a video about another quiet habit that generation mastered without ever making a fuss about it. It's linked right at the end of this one, and it might land even harder than this one did. So tell me, in the comments, which of these 10 envelopes does your family still practice, even if nobody in your house ever called it that? I read every single one.